Welcome to the deep dive.
Yeah.
You know, if your inbox is anything like mine, it's just, it's flooded, right? Economic news, market updates, endless analysis. It feels almost impossible sometimes to cut through it all and figure out what's actually going on.
Yeah, it's a lot of noise.
Yeah.
And that's really why we're here. Our goal, our mission with this deep dive is to try and give you a clear, concise, impactful look at the latest economic and market stuff. We're focused specifically on July 15th through the 21st, 2025.
Right. And we're basing this on a market outlook piece that honestly had some surprises this week. We found some trends that maybe run a bit counter to what you might expect.
Definitely. Like the U.S. consumer, we'll get into that, showing some real resilience. And also, where inflation is actually popping up and maybe more importantly, where it isn't.
Okay, let's dig in then. So the U.S. consumer, you said resilient. That feels like maybe an understatement based on this outlook.
Well, hanging in tough is how the source puts it. But yeah, I think resilient is right. It's actually acting as a really strong positive for the economy, defying some expectations. They're not just weathering the storm. They seem to be actively pushing things forward.
Actively pushing things forward.
Yeah.
Okay. So what's the hard data? Where are you seeing that specific strength?
The retail sales numbers, they really jumped out. They came in at plus 0.6%. The expectation was only a 0.1%.
Wow. Okay.
And remember, the prior month was actually down 0.9%. So that's a big swing. And it wasn't just one thing. It was like a rare month where almost all categories were positive, broad-based strength.
From negative 0.9 to positive 0.6. Okay. And across the board, that is a significant turnaround. Does this spending translate into how people feel? What about consumer sentiment?
It does seem to correlate. The University of Michigan's Consumer Sentiment Index, it climbed to 61.8. That beat the 61.5 expected and the 60.7 from before. But here's the really interesting part, the kicker maybe. This is a strong recovery from April and May. Back then, sentiment saw some of the fourth lowest readings in the past 50 years.
50 years. Wow. So people were feeling historically bad just a couple of months ago, and now this rebound.
Exactly. To bounce back like that from near record lows, well, it says something about how consumers are feeling right now. Optimism seems to be returning, somewhat surprisingly.
But confidence can be tricky, right? If people are worried about jobs, how does the job market fit into this picture of resilience?
Yeah, absolutely critical. And the job market seems to be, holding up its end. Thursday's jobless claims report came in at the lowest level in 3 months.
Lowest in 3 months. Okay.
So yeah, hiring has slowed down a bit recently. We know that. But this data suggests that, widespread layoffs, they're just not happening. That gives people a sense of stability, which likely feeds back into that confidence in spending.
All right. That makes sense. Job security underpins a lot of it. What about tariffs, though? We heard so much about how they'd impact consumers. Is that showing up?
Well, this is another surprise, frankly. The finding here is that tariffs have not yet harmed U.S. consumer spending habits.
Not yet. So consumers are just absorbing those costs for now.
It seems like it, at least based on this data. They appear to be shrugging off those extra costs, which, is another point strengthening this resilience narrative. Quite remarkable, really.
Okay, tariffs not biting yet, but that brings us straight to inflation, the other big topic. You mentioned earlier it's a tale of two indices this week. What's going on there?
Right. It's not a simple picture. On one hand, you have the Consumer Price Index, the CPI, that did show some tariff-induced inflation, as the source calls it.
Okay. Where specifically?
Things like apparel, furniture, bedding. You saw price increases there. Year over year, the overall CPI came in at plus 2.7%. So yes, consumers are paying more for certain items.
It's 0.7% year over year. Got it. Yeah. So that's one side of the tale. What's the other side?
The other side is the Producer Price Index, the PPI. This looks at prices from the producer's perspective, before goods hit the shelves. And that came in much, much tamer than expected.
How tame?
Flat, 0.0% for the month. The expectation was plus 0.2%, and the prior month was plus 0.1%. So, yeah, quite a slowdown there.
Zero. That is a big difference from the CPI story. Yeah. So producers aren't feeling the same heat or aren't passing it on yet. Why the split?
Well, the analysis suggests that some other sectors were actually kind of protected from price hikes. It seems companies built up inventory, to get ahead of the tariffs.
Oh, okay. So they stockpiled.
Seems like it. They managed to absorb or front run some of those costs. And what's really key here is the year over year PPI. It's now down to plus 2.3%.
2.3. Yeah, that's getting pretty close to the Fed's 2% target, isn't it?
Exactly. So you've got this nuanced picture. Some specific consumer items up due to tariffs, but broader producer price pressures seem to be easing off quite a bit.
Okay, so this mixed inflation picture, especially the cooling PPI,
Yeah.
where does that leave the Federal Reserve? You'd think maybe that opens the door for rate cuts, right?
You might think so, but not for July, it seems. The probability for a Fed rate cut this month, in July, actually fell again this week. It's down to just 2.6% probability.
2.6. Wow, so basically off the table for July then, despite that PPI number.
Looks that way.
But hang on, I thought I saw something about Fed Governor Christopher Waller pushing for a July cut, making some noise about it.
You did. He definitely made headlines. He argued the Fed rate is more than 1 full percentage point higher than it should be. It's a strong statement.
Yeah, it is. So is he swaying anyone?
Well, it's important to understand he's really a minority voice on the Fed right now. His view doesn't seem to reflect the broader consensus for this upcoming meeting.
Okay, so a lone voice for now, no cuts imminent. What about looking further out, the rest of 2025? Are expectations shifting there?
A little bit, yeah. The probability for cuts of, say, 50 basis points or more for the rest of the year, it did tick up slightly. Went from 62% last week to 64.6% this week.
So a bit more optimism for later cuts.
A touch more. But, and this is a big but, that probability is still much lower than what the market was expecting for, like, most of the past year. So yes, some expectation for cuts later on, but maybe not as deep or as fast as people once thought. The market's tempered its enthusiasm.
Okay, that makes sense. Cautious Fed, mixed inflation, but this surprisingly strong consumer. Let's pivot to the markets then. How is all this translating into where money is actually moving? You often hear that saying, right? As goes the consumer.
So goes the U.S. stock market.
Yeah.
Exactly. And given that consumer resilience we've been talking about, well, it's maybe not a huge shock that U.S. stock markets are continuing to roar ahead.
Roaring ahead. Which parts specifically?
Large cap stocks and growth stocks, in particular, both actually closed at record highs this past week. That seems like a direct reflection of that consumer strength feeding into corporate performance, especially for the big players.
Record highs. Okay. Can you give us the weekly numbers? Was everything up?
Not quite uniformly. Large caps, yes, they were up 0.6%. Growth stocks did even better, up 1.4%. And the NASDAQ, which is heavy on growth, gained 1.6%.
Strong week for them. What about the others?
Small cap stocks actually lagged. They were down 0.8% for the week, and value stocks were also down slightly, minus 0.5%. So a bit of a split, clearly favoring the larger growth names right now.
Interesting divergence within the U.S. What about globally? Did other markets follow that U.S. large cap lead?
Not really, no. Developed market stocks actually underperformed the U.S. They were down 0.1% overall. And if you look at large European stocks specifically, they fell 0.5%.
So developed markets lagged. What about emerging markets?
Now, that's a different story. Emerging market stocks actually had a strong week. They were up 2.2%.
Oh, wow. Plus 2.2. That's quite a jump compared to developed markets. Any particular reason for that strength?
Yeah, a lot of that seems to be driven by China. Chinese stocks were up 1.7% for the week. China continues to recover from those lows it hit back in early April of this year. That gave a nice boost to the whole EM complex.
So China's recovery is lifting the EM boat.
Okay.
And quickly, what about bonds? Any major moves there?
Yeah, bonds rallied a bit after a sell-off earlier in the week last Tuesday. The yield on the benchmark 10-year Treasury, it fell about 5.5 basis points over the week, closed at 4.37%.
Okay, 4.37 on the 10-year. Got it. So quite a week. Let's try and wrap this up. If you had to boil it down, what are the absolute key takeaways you want our listener to remember from this deep dive?
Okay, three main things, I think. First, that U.S. consumer, surprisingly resilient, really driving those U.S. stock market names, especially in large caps and growth. Second, inflation. It's a mixed picture, yes, but generally tamer, particularly when you look at that cooling producer price index, the PPI. And third, the Fed. They're cautious. July rate cuts look very unlikely, despite some noise. Expectations for cuts later in 2025 are still there, but maybe less aggressive than before. And globally, remember that divergence. Strong week for emerging markets, thanks largely to China, while developed markets lag the U.S.
That blend of signals, strong consumer, some specific inflation, but cooling producer prices, a cautious Fed, divided global markets. It really paints a complex picture, doesn't it? It leaves us with a thought for you, our listener, to consider. What does this unique mix actually mean for the economy's path forward, and maybe more importantly for your own financial outlook in the coming months? Definitely something to keep watching.